Namaskar, Assalamu alaikum, good morning. Today I have brought up the topic following up the previous video. Like the previous video was how to enter into the share market. Now this topic is to select a stock for long term. This is what I am saying, how to make a winning long term stock selection. So winning long term selection, when I am talking about long term, that means from 1 year to 5 years. So in this period, which stock are good for long term, that is this video I am going to describe. So focus on the fundamentals. The first thing the analyst suggests that focus on the fundamentals. When you are opening the website of any stock criteria to check any stock criteria, you will find a huge number of indicators. But here I am suggesting some of the very basic fundamentals. If you are paying attention on that, then definitely you will win, you will get huge money from the share market. So the first thing is dividend consistency. Consistency means that a company is paying dividend from many years. For the indicating or for you getting the confidence, you may check 2 year, 3 year, 5 year, up to 20 years. Analysts are suggesting, depending upon the amount of your investment. The larger the investment, please check it for long many years. So here the dividend gives us the confidence that the company is not only willing to share, they are predictable about their own company that they will perform better in future as well. Then the second one is examine the PE ratio. So PE ratio is not per share, it is profit per earnings ratio. So what does it mean? So it is actually when you open the website, you will find two types of PE. The first one is TTM PE. TTM PE means trailing 12 months. So how you calculate the trailing 12 month? So it is called like the TTM PE, the current share price. So share price at the moment, so price divided by last 4 quarters EPS. Now this EPS is earning per share. So 4 quarters earning per share. So this is always advised by all the stock exchanges that you have to publish the result every quarter, every 3 months. So this one TTM PE, once you note this number, then how much it should be. Because when you read the many websites, many articles, you will find that people indicating that 14 PE is an average ratio. But this is one indicator, but better to you compare this from TTM PE of current TTM with the sector PE. Like if you are investing, since I am talking about Bandhan Bank, so banking sector, so how much is the PE of banking sector, the whole overall sector? So overall sector, here it is indicating 18. So your TTM PE should be less than the sector PE. This indicates that share price will go up. So when sector PE is greater, sector PE greater than TTM PE, that means the share price will rise. But this also indicates that your dividend is going to be less. So when you are analyzing for the long term, you don't only depend upon the dividend, you see this TTM PE that if it is less than the sector PE, that means the share price is coming to up. Then the second thing that we are going to hear, watch for fluctuation earnings. Fluctuation earnings means there is a cycle in the market for economic growth as well as going it down. Sometimes it is going up and at the when it is going down, that means you have to evaluate or you have to recognize the cycle. In a long term, maybe like some problems are coming yearly, some problems are coming in 2 years or in 3 years. So if you recognize, then you can say that the price is less and in this region it's going up. So accordingly, you may plan your strategy. Then avoid value traps. Yes, This one is much more important. Value trap is some of the prices, the share prices is less, and also STTM PPE is less than the sector PE, but when you are seeing their overall liabilities, you will find that it's not only the showing the less, actual price should also be less. So please avoid that, and when you are checking for that, there are two ratios that we have to take care. The first one is debt ratio and the second one is current ratio. So how you calculate the debt ratio? Debt can working into two ways. Always remember that some of the company having huge liability or huge debts, but it is invested in some of the value earning projects. So if during the times of economic uncertainty or rising interest rates, companies with high level of debt can experience a financial problem. But that means if their debts are not invested, it's lying in their bank account or in their current account. In that sense, this may create a economic problem, financial issue for that share, for that companies. So debt ratio must be like you calculate total liability and total asset. However, total liabilities are declared, but total assets, this is tentative. So you see 2-3 years before that how much liability was previous and how much liability is now. That will give you a proper idea. Generally, the higher the debt, the greater the possibility that the company could be a value trap. So here, when the liability or the higher debt is much more than their peers, in that case, you must assume that there is a problem with this company. There may be with the problem. But just care, if this debt are invested in somewhere, some of the greater project, then do not worry, then have a patience, just check the timeline of their output, the invested project's output, and then we can see it again, then we can value it again. Then the second one is current ratio. Current ratio is current asset by current liability. This one is current ratio. This one is one of the important indicator, the current asset by current liability. So this one giving you exact idea that higher the number, the more liquid the company is. That means this number, this ratio is growing. Again, you compare with the sector PE or the sector current ratio or the peers current ratio. When you are selecting in the same sector 2, 3, 4 companies, in that time you have to check the current ratio of which company is higher. That means this company is more liquid. Let us say a company has a current ratio of 4. This means the company is liquid enough to pay 4 times of its liability. So current ratio means whatever the liability that can be paid their times. If it is 4, that means this company has the ability or the strength to pay its liability, current liabilities 4 times. That means the company is much more stronger or the superior. Then the next indicator is economic indicator. You know, economic indicator, there are 2 things to understand. Economic condition and evaluate the economic big picture. So what the big picture mean? Economic condition, I have already said that some of the share is growing up than their average, industrial average. So industrial average means this share we need to evaluate previous all 3, and if it is okay, then no problem. Otherwise, if the industrial average, that means the overall overall industry is not growing, but only one stock is sharing. In this condition, we must be cautious that there may be something wrong with this company. Then the second one is the big picture. Big picture means a good way to gauge how long term buy relate to the economy is to use news headlines. Here the things is news headlines, like you are watching TV, you are watching newspaper, you are using the social media. In social media, when the newses are contrasting to each other, that means there is a problem in overall sector, but some of the share is saving that ones. They are making the way how to come out from this. In the steel industry, most of the time we have seen the Tata Steel and Jindal Steel, both of them from the Indian market, both of them making the way to go up and other one getting down. So in that scenario, we have to look for the big picture. That means how many production unit and how many markets they are serving. So looking back, this news was clearly sign that market had a bottomed and stock were relatively cheap. So in this case, when you are seeing the market is going down and there is cheap share available, so please, before buying that cheap one, check their market serving, that how much share they are actually own. The next one is evaluate trouble down the road for the .com stock. This is one example. September 1999, that there was a news, getrich.com. It was a clear sign that troubles down the road for the .com stocks. So all the .com stock in between 90 to 99 has grown up very high, and at that time there was a sink came and then the market slowed down for them. So we have to, if we are buying, like one share you are buying many times and you are staying in that, so this can be a sign of excessive optimism or pessimism. However, these kinds of indicators can take a year or more than to take or to become its a reality. So like 1 year or 2 year time, it will be go down. But if you are indicating and you are signing that last month was this and this month came up, so that's not the real picture. So please beware of all that. And that's the bottom line. The bottom line of this whole story, when you are investing, that must be take care of, like when I am talking the long term, so patience and discipline, these two are some two fundamentals between the investor should always be followed. Like investment, discipline in the investment, like 100,000 you are investing every year and you are seeing this kind of stock you are investing. So please evaluate that discipline to continue, and then the patience when the market is going down, when there is performing, your stocks are not performing well. So during this indicator you evaluate many times and then take the decision. That's all. So this was for the long term investment. In the next video I am coming with swing trading. So swing trading, there is another one analysis called strength weakness opportunity threat, SWOT analysis, but that is only used for the swing trading. You don't apply that one into the long term investment. Long term investment, more or less these three things we need to consider. The first one, PE ratio, then the market fluctuation, the share fluctuation on cycle, current ratio, and more or less one more indicator we can go with, that the debt ratio. So debt ratio, current ratio for the long investor term, if you can figure out, that's the best indicator to invest in a particular stock. That's all for today. Bye bye.